Today we're going to come back again to discuss chapter 8, which is the sources of short-term financing using a book called Foundation of Financial Management, 18 editions by Block, Hurt and Danielson. Thesis owned in terms of by McGraw-Hill in terms of copyright. Okay, let's start with the learning objective, which is to remember trade credit from suppliers. That's number one. We call the bank loan that are usually short-term, and define the commercial paper and discuss how the account receivable and inventory as a collateral loan, and define the hedging and explain how it is used. What is the trade credit? Trade credit is approximately about 40% of short-term financing in its form of account payable or trade credit, such as account payable, which is a spontaneous source of funds, grows as business expense, contract when business declines. Payment period. In terms of trade credit, is usually extended for 30 to 60 days. Extended payment period to unsuccessful rank may alienate suppliers, diminish rating with Dun & Bradstreet and local credit bureaus. Major variable in the payment periods. Possible extent of cash discount. Okay. In terms of the non-cash discount policy, allow reduction in price of payment is made within a specific time period. Such as example, N net 30 cash discount means reduction of 2% if funds are remitted in 10 days after billing. Failure to do so means full payment after by the 30 days. Example, concern to take cash discount percent divided by 100% minus discount percent multiply by 360 divided by final due amount minus discount period. This is the logic given to you. We'll do that in detail and calculation later on. The net credit position determined by examining the difference between account receivable and account payable. Positive when account receivable are greater than account payable, and negative when the opposite is true. Larger firm tends to be net provider of trade and credit, relatively high receivable. Smaller firm typically in user position, relatively high payables. In terms of bank credit, banks provide self-liquidating loans. Use of funds is a built-in or automatic repayment scheme. Changes in the banking sector today center around the full concept of full service banking. It is expanded internationally to accommodate world and trade and international corporations. The largest interbank requiring expanding into the United States through bank acquisition and bank offices. Okay. In terms of recession, 2007 to 2009, the most severe Great Depression in 1930s, for many large banks to verge of the collapse, and the enactment of Gramm-Leach-Bliley Act in 1999, where commercial bank investment were allowed to merge. Merger allowed banks to take excess risk, which led to credit problems start to show up in 2007. In COVID-19, 2020, 2021, lesson learned from 2007 crisis created much more stable banking ecosystem. During a pandemic, bank failure will not be a problem. Small business were predominantly affected and faced bankruptcy. Federal government offered loan guarantees and payroll protection funding. This is what happens also in Canada. Small business given about, I think, 10,000 loan grant for COVID during period and can be returned at any time. And then prime rate and LIBOR. Prime rate is rate bank charges on the most creditworthiness of customer increase as customer credit risk increases. London, which is London Interbank Bank Offer Rate offered to companies with international presence, ability to use London Euro Dollar market for loans, and will be replaced by Sterling Overnight Index Average, which is SONIA. I remember when I used to work for Nomura Securities, we raised a lot of fund in Euro bonds by using LIBOR as a base in terms of interest rate calculation. So that is the standard that we use when I was working for Nomura. When we are using Euro bond, and when we issue Yankee bond as well as any local domestic bond, we always use LIBOR as the base. And then the prime rate versus LIBOR on the US dollar basis. You see here the bank prime loan rate is the blue color. The LIBOR will be as below it, exactly moving in the same chart. Okay, so the red one is the LIBOR. The bank prime rate is also the blue one. So it's gonna move in tandem. It's like move up and down, move up and down. In terms of compensating balances, minimum average account balance maintained as alternative to fee charged by a bank for service rendered when interest rates are lowered, compensating balance rises. When computing balance are required to obtain loan, computed balance are required to obtain loan. Computed balances are required to obtain the loan. Computed as a percentage of customer loan outstanding. Computed as a percentage of bank committed toward the future and given account. Computing bank continued. In terms of borrowing, amount must be borrowed is calculated by taking needed funds by dividing by 1 minus C, where C is computing balance expressed as decimal point. Example, if 100,000 is needed, amount borrowed must be 125,000. Considering 20% of bond borrowed is computed as follows. Okay, amount borrowed, amount needed, which is 1 minus C, 1 minus 2, so we're going to calculate, will give me 125,000. This is how you're going to calculate, okay? Amount needed divided by 1 minus C, needed funds equal to 101 minus 0.2, which is 20% amount borrowed on compensating balance, 125,000. In terms of maturity preservation, the term loan is a credit extend for 1 to 7 years. Loan usually paid in monthly or quarterly installment. Only superior credit applicant can qualify. So you have a AAA rating, that's good, then you can do that. Okay, anything that's A rating, they usually can do that. A company that has that kind of rating. Interest rate fluctuate with market conditions. Interest rate may also be tied up with prime rate or LIBOR. In terms of cost of commercial bank financing, effective interest rate is based on loan amount, dollar interest rate, length of a loan, method of repayment. So effective rate equal to interest divided by principal times days of in year divided by days of loan outstanding. Okay, so we're gonna look at this logic here in case of discounted loan. Example here, you get a 1,000-year loan with 60 interests deducted. Advance represent payment and interest only for 940. Effective rate is 6.38%. 60 divided by 1,000 minus 60 times 360 divided by 360 for 1 year, which is about 60, divided by 940, you got 6.38. This is the typical calculation in terms of effective rate, okay? Assuming again 6% as stated annual rate, the 20% compensating balance, so interest minus 1C, 601.2, so the effective rate or compensating balance will be 7.5 using the same formula. When the amounts are used, the stated rate is not known, the following can be used for computation. Effective rate with compensating balance equal to interest divided by principal minus compensating balance in dollars multiplied by days in a year divided by days of loan in outstanding. So when you calculate instead loan in series of equal payment over the life of the loan, the effective rate of interest on installment loan would be almost double what the rate of interest. Effective rate of installment loan would be 2 times annual number of payments times interest divided by total number of payments plus 1, close bracket, times principal. When you plug in those numbers, you're going to get 11.08%. Okay, this is how you get that number. You just plug in the number. Okay, in terms of annual percentage rate, Truth in Lending Act 1968 requires actual percentage APR given to borrower, okay, to make sure the borrower knows what is the effective rate, the APR. Annual percentage rate is required to use accrual method compounded interest during the compounding computation of APR. Lender must calculate interest for period on outstanding loan balance at the beginning of the period. Based on the assumption of annotation according to the law, a loan administration schedule is the final authority in the calculation of APR. Okay. For reserve, tighten the growth during the credit crunch phenomenon. The reserve tighten the growth in money supply to combat inflation, causing to decrease in lendable fund and increase interest rate and increase in the demand of fund, carry inflation laden inventory and receivable, massive withdrawal of saving deposit at banking to institution fueled by search of higher return. This is what's going on when there is a tightened growth in money supply to combat inflations. Okay, this is what happens also so far in Canada now in 2024 to fight inflation. Interest rates goes up. The credit condition can change dramatically in sudden due to unexpected default, economic recession, changes in monetary policy, as well as other economic setback. In terms of commercial paper, financing to commercial paper, it is used to represent short-term unsecured promissory note, usually issued to public a minimum of 25,000. So this is the standard practice to doing a commercial paper for any company. Form of commercial paper, finance paper, direct paper, paper sold by financial firm that go to lender, dealer paper sold by companies through dealer network, asset-backed commercial paper, book entry transaction, computer handling. In terms of commercial paper, there's no actual certificate created. So in terms of commercial standing, is going up here. The blue one is commercial paper. The green one is asset-backed commercial paper outstanding. The red one is the direct financial paper outstanding, and the light blue is the dealer non-financial outstanding. That's the highest degree commercial paper. Okay, pending paper. There you go. This is the highest one. Okay, the advantage of having commercial paper may be issued at below prime interest rate, usually normally 2 to 3%. No association in compass and balance measurement, and associated with prestige for fund to float paper for in the snobbish market for funds. Okay, many lenders, there's a limitation as well in terms of issuing paper. Many lenders have become risk-averse after multiple bankruptcy, corporate fraud, and other events. One of the biggest corporate fraud is Enron. It created a lot of problems there. And then there's also another issue. Lehman Brothers went bankrupt as well. Firms with downgraded credit rating do not have access to market as well. Associated with are less predictable, like degree of commitment and loyalty that is associated with more expensive bank loan as well. Okay, this is an example of commercial paper rate to prime rate, annual rate. This is, you get this paper here, 3 months, and the prime rate here 9.5%. Prime rate minus finance paper, so you got 3.16%. The average here, show you the average of the prime rate here. This is the prime rate minus the finance paper. Okay. In terms of foreign borrowing, there's a euro-dollar loan denominated in dollars made by foreign bank holding in dollar deposits, short-term to immediate term maturity. LIBOR is the base interest rate paid for loans for companies on highest quality. Borrowed from interbank in foreign currency directly through foreign subsidiary. Can convert foreign currency into dollars and send to parent company. Borrowing firm may also suffer currency risk. Okay, because of the foreign exchange risk exposure. Secure credit arrangement. When credit rating of borrower is too low, need funds very high. Remain concerned whether the borrower can generate enough cash to liquidate loan when coming due. Uniform Commercial Code. This is a standard practice. There's a code adopted by all states in the U.S. Standardized and specified procedure code and established security against the loans. Okay. In terms of account receivable financing, include pledging account receivable as collateral of a loan, factoring for outright sale of receivable. The advantages permit borrowing to be tied directly to the level of asset expansion at any point in time. Disadvantage will be relatively expensive method in acquiring fund. Lending firm decide which account receivable you use account for the loan. Usually, loan percent depends on firm financial strength, credit worthiness of his account. Interest rate well above the prime rate compared against the balance outstanding. So this is a typical factoring. You can use it for any receivable balance. Again, example here: month 1 to month 4. Receivable outstanding, account receivable fund to finance company from 10,000, 14,000, 18,000, loan balance 80%, so interest rate 8 given to you. This is typical factoring process. Receivable are sold outright to finance company. Factoring firms do not have recourse against seller of receivable. Finance company may do all part of credit analysis, ensure quality account. So that is basically factoring, basically the good quality name of the company as well as credit risk. They have to do their own analysis to make sure when they buy the AR, they are good company. Okay, factoring firm absorb the risk, actually advance funds to seller at a lending rate. Example here: 100,000 processed in 1% commissions, 12% in annual borrowing rate. Effective rate, example here: 1% commission, 1% interest for 1 month, which is 2% total fee monthly, 2% monthly, which is 24% annual rate. Rate may not be considered high due to factor transfer as well as early received funds, and allow funds to pass on much credit risk cost to factoring. Increasing trend in public offering security backed by receivable as collateral. Okay, there's a public offering security backed as collateral. Interest paid to owners is tax-free and varies to firm. Trade future cash flow for immediate cash. Carry high credit rating of AA or better. Provides corporate liquidity as well as short-term financing. But the disadvantage to buyer is risk associated with the they're actually being paid. Okay, in terms of inventory financing, factoring issue or use of inventory, marketing of pledged good, associated price of stability, perishable of the product, degree of physical that can exercise over the product. Stage of productions, Raw materials and finished goods usually provide best collateral. Good interest may qualify for only small percentage of loan. The nature of the lender loan provides great assurance to lender but higher administrative costs. The type of arrangement, such as blanket inventory lien, lender has general claims against inventory, tax receipts such as floor planning, and instrument acknowledge that borrower holds inventory and proceeds from sales in terms of trust with the lender. For warehousing, receipt is issued, goods can be removed only with the lender's approval. This is create a lot of administrative work. Okay, public warehousing with warehousing firm, field warehousing on borrower's premises. So if you do a warehousing receipt, there's a lot of paperwork that you have to do to get through that process in terms of the arrangement. Okay. Appraisal of inventory control device must have control user involved. Substantial administrative expensive. That's I agree with this is a lot of paperwork. Raising overall cost of borrowing. That's correct. Extension of fund well with need because of the administrative cost is very high if you do inventory costing cost. There's high turnover. Can you imagine if you are operating a Canadian Tire store, how many inventory that you have to track? That's a lot of paperwork. Hedging the reduced borrowing risk, engaging in the transaction that partially or fully reduced prior risk exposure. The financial feature of the futures market allow trading of financial instrument at future point in time and no physical delivery of goods but execution of later transaction that reverse initial position. Example, initially sell a future contract, then later buy a contract to cover the initial and vice versa. So this is basically in the many commodity market and Chicago Stock Exchange. It's been done many times. You buy and sell a contract for the futures. Sales price is a good example here, 100,000. 95,000 in selling of treasury bonds here, future contract, pattern interest rate, determine hostility, sale price is 100,000, purchase 95,000. Okay, then you get the profit of future contract. This is usually that you can do that. Purchase of price future, establish the time when is the purchase of transaction. You can do this. Okay, selling buying contract. Okay, interest bond future contract. Then if interest rate increase, extra cost of borrowing money to finance business can be offset by the profit of future contract. If interest rate decrease, however, loss on future as a bond rises, offset by lower borrowing costs of the financing form. So the price, the interest rate increase and decreases will create a different effect. Increase in interest rate, for example, will be an extra cost of borrowing. Decrease in interest rate will create a loss in the future contract. Okay, as bond price rises. Okay, that's the thing. You have an inverse relationship. Okay. All right, guys. Let me check. This is basically closing the chapter 8 of the corporate finance. Hopefully you enjoy this, and there will be uploaded in YouTube and will be also available in Edpuzzle, so you can view that and you can practice it for your class. Okay, hope to see you in the next chapter. Bye bye.